Okay, let's unpack this. Today, we're taking a deep dive into Hindustan Unilever Limited, HUL, a real giant of India's fast-moving consumer goods sector. Our mission really is to pull out the key insights from, well, a pretty thorough financial and market analysis of HUL. We're looking back fiscal year 2015 right up to 2025. Consider it your quick guide to understanding this market leader. Now, HUL, as you probably know, it's a major subsidiary of the global Unilever pairs. They're huge in home care, beauty and personal care, and foods and refreshment. They have what? Over 50 brands. And get this, 19 of those pull in over 1,000 crore rupees every year. We're talking Surf Excel, Dove, No, brands you definitely know. And their reach, HUL products are in roughly 80% of Indian homes. Just think about that for a second. If you wanted to launch a competing product, HUL is already inside 4 out of 5 houses. It's not just market share. It's a massive barrier to entry, right? A whole network of distribution and loyalty.
Exactly. And that incredible reach, it's not just a statistic. It really forms the foundation for their financial strength. So how does that actually look on the books? What's the financial story here?
Well, over this past decade, their consolidated sales pretty much doubled. Went from around 32,000 crores in 2015 to 63,121 crores in 2025.
Doubled, okay.
And net profit, more than doubled, hit 10,671 crores. That kind of steady growth, even for a company this big, it just underlines how dominant they are.
Right. So beyond just the top line sales and profit numbers, what specific financial metrics really jump out when you dig into HUL's performance over the last decade, especially for a company of this, sheer size?
Well, one thing that's really striking is their debt, or rather the lack of it. In 2025, their debt-to-equity ratio was 0.00. Basically, they operate almost completely debt-free. That's pretty exceptional for such a large corporation.
There's no debt. Wow. Yeah. And that financial discipline, it's not just about playing it safe. It gives HUL enormous strategic flexibility. Think about it. They can make acquisitions, invest big in new tech, or, ride out a nasty economic downturn without being dragged down by interest payments. That's a huge competitive advantage.
A weapon, almost.
It really is. Plus, their return on equity, the ROE, which basically measures how well they use shareholder money to make profit, has stayed consistently strong. It was 21% in 2025, shows really good capital efficiency.
Okay, so the financial engine looks really solid.
Yeah.
But for you, the listener, maybe thinking long-term investment, what's the actual return been like from this powerhouse?
Well, it definitely points to strong cash flow. Look at their dividends. The dividend per share jumped significantly from 16 back in 2016 to 53 in 2025. And they have a high payout ratio, too. That tells you the company feels confident about its future earnings and wants to give value back to shareholders. Now, if you zoom out a bit, HUL's success is obviously tied to the wider Indian FMCG sector. And that sector is expected to grow quite a bit. A CAGR, compound annual growth rate, of over 20% is projected for the next few years.
Driven by what? More income, people moving to cities.
Exactly. Rising disposable income, more urbanization, and also, importantly, a huge untapped rural market still exists.
And it seems like HUL isn't just sitting back, right?
Yeah.
How are they using tech or new channels to tap into that growth?
Precisely. They're focusing strategically on premium products, digital transformation, and expanding into health and wellness. They even made acquisitions like Oziva.
Right, I heard about that.
Yeah. And their Shikar app, for instance, connects directly with over 1 million retailers. Plus, their push into e-commerce and D2C that's direct-to-consumer now makes up about 30% of their digital demand. They're trying to stay ahead.
So it sounds like, a well-oiled machine, constantly adapting.
Yeah.
But, okay, every deep dive needs to look at the potential downsides, too. While HUL's stock has done well long-term, 176% return over 10 years, it's actually lagged behind the market benchmarks more recently, like the last 1 to 5 years. Over the last year, for example, was actually down negative 4.42%, which feels a bit odd for such a dominant company.
Yeah, that's the key question, isn't it? Why the recent sluggishness despite the strong fundamentals? Well, you've got factors like tougher competition, especially from these nimble DTC brands, and also swings in raw material prices. But some technical indicators might offer clues too, things like their Day Relative Strengths Index, RSI, and Money Flow Index, MFI, they're currently showing as overbought.
Meaning?
It sort of suggests the stock price might have run up a bit too fast compared to its immediate fundamentals, leading investors to maybe take some profits or just pause. A natural correction, perhaps?
We should probably also quickly mention some of the corporate responsibility issues they have faced. There was the Kodaikanal mercury issue, which, was settled back in 2016, but it raised environmental questions. And more recently, the parent company, Unilever Pills, has faced some heat over plastic packaging and even calls for boycotts related to its operations in Russia.
Right. And while those controversies definitely touch on crucial areas of corporate responsibility, the analysis seems to show they haven't really put a major dent in HUL's actual turnover. That's probably down to their proactive sustainability efforts, yes, but also that incredibly deep brand loyalty they've built up over many, many years. It shows good crisis management, but it's also a reminder that these ethical considerations are always there for big companies.
Okay, so wrapping this up, what does this all mean for you? HUL is, well, undeniably a fundamentally strong company. Deep market reach, set to benefit from India's consumption growth story long term. But, and it's a big, but its current market price looks quite high. It reflects a significant premium.
And that leaves us and you with a really interesting question. How do you balance a company's obvious quality, its market dominance, the strong cash flow, the consistent dividends, against a valuation that, if you use conservative methods like, say, Benjamin Graham's principles, looks seriously stretched? We calculated a sort of intrinsic value around 661.67 based on that approach, compared to its current trading price of about 2,509.80. So what does that tell you about judging a good investment today, especially when quality often demands a premium? How do you decide when that premium is just too high? It's something to think about.